I need you to listen to me very carefully for the next few minutes. If you're over 60, this could be one of the most important messages you hear about your money this year. I want to talk about your bank account, the money you've spent a lifetime saving, the money you are counting on to see you through a comfortable retirement. You've always prided yourself on being financially responsible. You paid off the mortgage. You raised your family. You saved what you believe is enough. But have you ever looked at your bank statement and had that sinking feeling in your stomach? A feeling of confusion? Because the numbers just don't add up. You see fee after fee, and you realize with a sense of cold dread that your savings are bleeding away and you don't know why. If that sounds familiar, you are not alone. Today, I have to issue a serious warning. Across America, millions of seniors are losing thousands, even tens of thousands of dollars every year to banking habits that once seemed completely harmless or even responsible. This isn't about stock market crashes or get-rich-quick scams. This is a quiet, insidious drain on your retirement savings, happening one small fee, one outdated habit, one missed opportunity at a time. The cruel irony is that the generation that learned to be careful with every penny, that trusted in the safety of the local bank, is now being systematically drained by the very institutions they have been loyal to for decades. The banking world has changed, but many seniors are still playing by the old rules, and it's costing them dearly. To show you exactly what I mean, I want to tell you about a client of mine. Her name is also Margaret. At 67, she was in that exact situation. Staring at her bank statement, she discovered that in the past year, small, seemingly insignificant fees had siphoned nearly $4,000 from her savings. $4,000 she desperately needed for medical bills. Margaret's story is a wake-up call. Her 5 most damaging banking habits are the same habits shared by millions of you. Let's break them down, because understanding them is the first step to stopping the bleeding and protecting your financial future. The first habit that was quietly destroying Margaret's financial security was one that seems completely reasonable: maintaining multiple accounts at different banks. She did this because she believed it provided security and helped her stay organized. Does this sound like you? She had her main checking account at First National, where she'd banked for nearly 40 years. She kept a savings account at a different bank because they'd offered her a free toaster back in 1987. She had another small checking account at a third bank because her daughter had recommended it, and a money market at a credit union because a friend said the rates were better. On the surface, this looks like smart diversification. In reality, it was a financial disaster. This seemingly prudent habit was costing her over $2,000 a year in maintenance fees alone. Because her money was scattered, none of her individual account balances were high enough to meet the minimums required to waive the monthly fees. So at 4 different banks, she was being charged a fee, anywhere from $8 to $25 a month, for the privilege of letting them hold her money. But the fees were just the beginning. The real damage came from what we call inefficient cash management. With her money spread thin, Margaret was constantly moving funds around to cover checks or pay bills. This often triggered transfer fees, and worse, when the timing was off, it led to expensive overdraft charges. This scattered approach also meant she was missing out on the significant benefits that come from consolidating your banking. By being a small fish in 4 different ponds, she didn't qualify for the preferred customer status at any of them. A single bank, where she would have been a valued customer, would have likely offered her fee waivers, better interest rates, and premium services for free. Finally, think of the mental cost. Managing 4 different logins, 4 different statements, and 4 different fee schedules is a nightmare. It's nearly impossible to have a clear picture of your financial health, and it's exhausting. When we finally sat down and consolidated her accounts into a single, senior-friendly program at a credit union, she instantly eliminated over $1,500 in annual fees and started earning more interest. This leads us to the second devastating banking habit, one born from a mindset that feels safe, but is actually incredibly risky: keeping all your money in checking and traditional savings accounts. Margaret was terrified of the stock market. She'd seen friends lose money and had lived through enough downturns to believe that cash was king. So her emergency fund, her retirement savings, her inheritance, all of it sat in accounts earning between 0.01% and 0.5% interest. This ultra-conservative approach felt safe, but in reality, it was a guaranteed way to lose money. While her money was earning next to nothing, inflation was running at 3%, 4%, even 7% a year. The mathematics are brutal. Her $200,000 in savings had lost approximately $60,000 in purchasing power over the last 8 years. She had the same number of dollars in her account, but those dollars could buy significantly less food, gas, and health care than when she first retired. The tragedy is there were safe alternatives available. Online banks were offering FDIC-insured CDs with 4 to 5% returns. Government treasury bills were providing even better returns. Her fear of risky investments was causing her to take on the biggest risk of all, the certainty that her money's value would be eroded by inflation. The most infuriating part for her was learning that her bank was taking her deposits, paying her less than 1%, and then lending that same money out for mortgages and car loans at 6%, 10%, even 15% interest. She was providing her bank with free capital to generate enormous profits, and she was getting almost nothing in return. Her conservative approach wasn't protecting her. It was ensuring she would lose in a game that was rigged against her. Margaret's third catastrophic habit is one that millions of seniors share, paying bills manually by writing and mailing checks. She avoided online banking and automatic payments because she thought they were too complicated or unsafe. This old-fashioned method was costing her thousands. First, there were the direct costs, nearly $300 a year in stamps, checks, and envelopes. But the hidden costs were the real killer: late fees. Despite her best efforts, Margaret had paid over $800 in late fees last year because checks got delayed in the mail, or she simply forgot a due date. And those late fees create a cascade of other problems. A late credit card payment meant not only a $35 fee, but also a penalty interest rate increase. A late insurance payment risked a lapse in coverage. Her manual system was also causing her to miss out on significant discounts. Her car insurance offered a 5% discount for automatic payments. Her phone company, a $10 monthly discount. Her mortgage servicer, an interest rate reduction. In total, she was forfeiting over $1,200 a year in savings simply because she insisted on mailing checks. And her security concerns were completely backward. She was worried about online hackers, but she was mailing checks with her name, address, bank name, account number, and signature all on one piece of paper. A fraudster's dream. Modern online banking with its multi-layer security is vastly safer than sending a check through the mail. The fourth banking habit that was steadily draining Margaret's retirement security was perhaps the most emotionally painful to confront. Remaining loyal to the same bank for decades without ever comparing their services, fees, or offerings to what was available elsewhere. This loyalty, which Margaret viewed as a virtue, had become a financial trap that was costing her thousands of dollars annually and preventing her from accessing services that could dramatically improve her retirement security. Margaret had been banking with First National for 38 years, since she and her late husband opened their first joint checking account there as newlyweds. She'd received her first mortgage there, financed their cars there, and maintained all of their primary accounts there throughout their marriage. The bank felt like family. She knew several of the tellers by name, had worked with the same branch manager for over a decade, and took comfort in the familiar routines of visiting the same location where she'd conducted banking for nearly 4 decades. But Margaret's loyalty had been one-sided. While she'd remained faithful to First National, the bank had changed dramatically around her. It had been acquired by a larger regional bank, then by a national corporation, and finally by one of the country's megabanks. With each acquisition, the fees had increased, the interest rates had decreased, and the personal service that Margaret valued had gradually disappeared. The tellers she knew had been replaced by automated systems. Her branch manager had been reassigned, and the bank's focus had shifted to younger customers with different needs and higher profitability. The financial impact of her misplaced loyalty was staggering. First National was charging Margaret $25 monthly for her checking account because her balance had fallen below their $10,000 minimum requirement after paying for her husband's medical expenses. Their savings account was earning 0.01% interest, while online banks were offering 4 to 5% for identical FDIC protection. Their CD rates were 2, 3. percentage points below what she could earn at credit unions or online institutions. Even their ATM fees had increased to $3.50 per transaction for non-network machines, adding up to over $200 annually for Margaret's routine transactions. When Margaret's advisor conducted a comprehensive comparison of her current banking arrangement against alternatives available to her, the results were shocking. By switching to a credit union that actively courted senior customers, Margaret could eliminate all monthly fees, earn 20 times more interest on her savings, and access a network of fee-free ATMs that was actually larger than her current bank's network. The credit union also offered financial planning services, estate planning assistance, and other benefits specifically designed for retirees. But the opportunities went beyond just switching institutions. Margaret discovered that many banks offered premium services for customers her age with substantial assets, services that could save her thousands of dollars annually while providing concierge-level support for her financial needs. Private banking programs designed for seniors offered features like dedicated relationship managers, fee waivers, enhanced interest rates, and priority customer service. Some banks even offered to reimburse ATM fees from other institutions, provide free investment consultations, and assist with estate planning. The most painful revelation was that First National actually offered many of these premium services, but they'd never informed Margaret about them because she'd never asked, and they had no incentive to reduce their fee income from her accounts. Her loyalty had made her a complacent customer, and the bank had taken advantage of that complacency to maximize their profits from her relationship. Margaret's advisor explained that the banking industry had become intensely competitive, particularly for customers with substantial assets. Banks were offering increasingly attractive packages to win new customers, but they rarely extended these benefits to existing customers who weren't threatening to leave. Margaret's loyalty, rather than being rewarded, had actually disqualified her from receiving the bank's best offerings. The emotional difficulty of confronting this reality couldn't be understated. Margaret felt betrayed by an institution she'd trusted for decades, and she felt foolish for not recognizing how one-sided the relationship had become. But her advisor helped her reframe the situation. Her loyalty wasn't the problem, her passivity was. By becoming an active consumer who regularly evaluated her options and advocated for better treatment, she could maintain relationships with institutions that truly valued her business. When Margaret finally initiated conversations with other banks and credit unions, she was amazed at the welcome she received. As a retiree with substantial assets and a long history of responsible financial management, she was exactly the type of customer these institutions wanted to attract. The competition for her business resulted in offers that were dramatically superior to what she'd been accepting at First National. Margaret's fifth and perhaps most devastating banking habit was one that she'd never even recognized as a choice: keeping large amounts of money in checking accounts because it felt liquid and accessible, while missing opportunities to put that money to work, earning returns that could significantly enhance her retirement security. This habit of maintaining excessive cash reserves in low-yielding accounts was costing her tens of thousands of dollars in lost investment growth and creating a false sense of financial security. At any given time, Margaret maintained between $50,000 and $80,000 in her various checking accounts. This wasn't intentional. It was the result of irregular income from Social Security, pension payments, and occasional distributions from her IRA, combined with irregular expenses and her fear of running short of readily available funds. She viewed this large cash cushion as prudent financial management, but her advisor helped her understand that it was actually one of her most expensive habits. The opportunity cost was enormous. That $65,000 average balance in checking accounts earning zero interest represented a massive drain on her potential retirement income. If that money had been invested in even conservative investments earning 5 to 6% annually, it would have generated $3,000, $4,000 in additional income each year. Over the course of her retirement, this difference could amount to hundreds of thousands of dollars in lost wealth accumulation. Margaret's excessive cash hoarding stemmed from several psychological factors that are common among retirees. She had an exaggerated fear of market volatility. Having lived through several market downturns that had temporarily reduced her investment account values, she overestimated how much liquid cash she actually needed for emergencies, keeping enough money immediately accessible to cover expenses that she could realistically handle through other means. And she had an outdated understanding of how quickly investments could be converted to cash when needed, assuming that any money not in a checking account was effectively inaccessible for months. The reality was that Margaret's true liquidity needs were much smaller than her cash reserves. A detailed analysis of her expenses revealed that she could comfortably operate with $10,000, $15,000 in checking accounts, keeping the remainder in investments that could be converted to cash within a few business days if needed. Money market funds, short-term treasury bills, and conservative bond funds all offered significantly better returns than checking accounts while maintaining near-cash liquidity. Her advisor introduced Margaret to a concept called cash flow laddering, structuring her investments so that different portions would mature at different times, providing regular liquidity while keeping the majority of her funds earning meaningful returns. This approach would allow her to maintain the security she valued while dramatically improving her investment returns. The most eye-opening revelation was understanding how her excessive cash habit interacted with inflation to guarantee that she was losing money. With inflation running at 4 to 6% annually, her zero-interest checking account balances were losing 4 to 6% of their purchasing power every year. She was essentially paying the bank to store money that was guaranteed to become less valuable over time. This wasn't conservative investing. It was a guaranteed loss strategy. Margaret also discovered that her large cash balances were creating tax inefficiencies. The minimal interest she was earning was subject to ordinary income tax rates, while investment gains could potentially be taxed at lower capital gains rates or deferred entirely in tax-advantaged accounts. Her cash-heavy approach was not only earning poor returns, but subjecting those meager returns to the highest possible tax rates. When Margaret's advisor showed her a detailed projection of how her retirement could be transformed by optimizing her cash management, the numbers were staggering. By keeping appropriate emergency reserves in high-yield savings accounts and investing her excess cash in age-appropriate portfolios, she could potentially increase her annual retirement income by $8,000, $12,000, while actually reducing her overall risk through proper diversification. The emotional journey of confronting these habits was as challenging as the financial recalculations. Margaret had to acknowledge that strategies that had served her well during her working years were now working against her in retirement. The financial landscape had changed, her needs had evolved, and her approach needed to adapt accordingly. But Margaret's story represents both a cautionary tale and a message of hope. At 67, she still had time to make changes that could dramatically improve her financial security. The habits that had been quietly draining her wealth for years could be reversed, and the cumulative impact of those changes could add hundreds of thousands of dollars to her retirement security over the next 15 to 20 years. The first step in Margaret's transformation was the hardest, admitting that her current approach wasn't working. This required overcoming decades of ingrained habits, confronting fears about financial complexity, and accepting that the institutions she'd trusted weren't necessarily acting in her best interests. But once she acknowledged the problem, the solutions became surprisingly straightforward. Margaret began by consolidating her accounts at a credit union that specialized in serving senior customers. This single change eliminated over $1,500 in annual fees, while providing better service and significantly higher interest rates. The credit union's senior-focused approach meant that they actively helped Margaret optimize her banking relationships rather than simply extracting fees from them. Next, she automated her bill-paying system, setting up online banking with proper monitoring and alerts. This eliminated late fees, captured automatic payment discounts, and freed up hours of time each month while actually improving her financial security. The system felt intimidating at first, but the credit union provided personalized training that helped Margaret become comfortable with digital banking. Perhaps most importantly, Margaret worked with a fee-only financial advisor to develop an investment strategy appropriate for her age and risk tolerance. This didn't mean taking on inappropriate risks. It meant understanding the difference between smart risks and stupid risks. Keeping all of her money in accounts earning less than inflation was a stupid risk that guaranteed losses. Investing in properly diversified, age-appropriate portfolios was a smart risk that gave her money a fighting chance against inflation and the potential to fund a more secure retirement. The transformation wasn't immediate, and there were moments when Margaret second-guessed her decisions. Old habits and fears don't disappear overnight, and the financial industry can seem intimidating to seniors who've operated under different assumptions for decades. But the results spoke for themselves. Within 6 months, Margaret's monthly fees had dropped to nearly zero, her investment returns had improved dramatically, and her overall financial management had become both more efficient and more effective. More importantly, Margaret had regained a sense of control over her financial future. Instead of watching her wealth slowly bleed away through fees and inflation, she was actively building the security she needed for her remaining years. The anxiety that had plagued her for years as she watched her expenses increase while her savings stagnated was replaced by confidence in a plan designed to help her money last for the rest of her life. Margaret's advisor emphasized that her situation was far from unique. Millions of American seniors are making similar mistakes, often without realizing the cumulative impact on their financial security. The banking industry has changed dramatically in recent decades, but many seniors continue to operate under assumptions that are no longer valid. Banks have become less personal and more fee-driven. Inflation has made cash-heavy strategies untenable, and technology has created opportunities for better banking relationships that many seniors haven't explored. The 5 habits that were destroying Margaret's financial security: maintaining multiple fee-generating accounts, keeping all money in low-yield bank accounts, avoiding automation and online banking, remaining loyal to banks that don't reciprocate, and hoarding excessive cash, represent some of the most common and most expensive mistakes that seniors make with their money. But these habits persist not because seniors are financially irresponsible, but because they represent the intersection of outdated assumptions, industry changes, and natural psychological tendencies. The strategies that worked well during the high interest rate environment of the 1980s and 1990s don't work in today's low-rate environment. The personal banking relationships that once provided value and guidance have been replaced by automated systems designed to maximize fee extraction. And the financial complexity that has emerged over the past 2 decades can be overwhelming for seniors who learned money management in a simpler era. Understanding why these habits develop helps explain why they're so persistent and why changing them requires more than just providing information. Margaret's multi-bank habit reflected a Depression-era mindset about diversification and security that made perfect sense given her life experiences. Her preference for paper checks and manual systems reflected reasonable concerns about technology and security, even though those concerns were no longer aligned with current realities. Her bank loyalty reflected values about relationships and commitment that are admirable in personal contexts but counterproductive in commercial relationships. The key insight that transformed Margaret's approach was understanding that being a smart financial consumer in today's environment requires active management and regular optimization. The set-it-and-forget-it approach that worked well during her working years was now working against her in retirement. Banks, investment companies, and other financial service providers have every incentive to extract maximum fees from passive customers, which means that protecting your wealth requires becoming an informed and active participant in financial decisions. This doesn't mean that seniors need to become day traders or financial experts. It means understanding that the financial services industry has become more competitive and more complex, which creates both opportunities and threats. Seniors who learn to navigate this environment can access services and returns that were unavailable to previous generations of retirees. Those who don't adapt find themselves systematically disadvantaged by institutions that profit from their passivity. Margaret's transformation also highlighted the importance of working with advisors who understand the unique challenges facing senior clients. Many financial advisors focus on younger clients who are accumulating wealth, but retirees have different needs that require specialized expertise. Fee-only advisors who specialize in retirement planning can help seniors optimize their banking relationships, investment strategies, and overall financial management, without the conflicts of interest that plague commission-based advisors. The emotional aspects of Margaret's journey were as important as the technical changes. Confronting decades of financial habits required acknowledging that she'd been making expensive mistakes for years, which was initially devastating to her self-image as a financially responsible person. But her advisor helped her reframe these mistakes as reasonable responses to a changing environment that required updated strategies. The guilt and self-recrimination that initially accompanied Margaret's financial awakening gradually gave way to empowerment and optimism, as she realized that she still had time to make changes that would significantly improve her retirement security. At 67, she had a potential 15 to 25-year retirement ahead of her, and optimizing her financial strategies for this period could add hundreds of thousands of dollars to her legacy while funding a more comfortable and secure lifestyle. Margaret's story also illustrates how these seemingly separate banking habits actually compound each other's negative effects. Her multiple accounts made it harder to qualify for fee waivers, which increased her costs and made her more likely to keep large cash balances to avoid overdrafts. Her manual bill-paying system interacted poorly with her scattered accounts, creating overdraft fees and missed payment discounts. Her loyalty to banks that didn't reciprocate prevented her from accessing better rates and services that could have partially offset her other suboptimal strategies. This interconnectedness means that addressing one habit without considering the others provides only limited benefits. But it also means that comprehensive changes can have multiplicative positive effects. When Margaret consolidated her accounts, automated her payments, and optimized her cash management simultaneously, the benefits were much greater than the sum of individual improvements. The banking industry's evolution over the past 2 decades has created both challenges and opportunities for senior customers. The consolidation of banks has eliminated many of the personal relationships that seniors valued, but it has also created intense competition for deposits that savvy customers can exploit. The rise of online banking has eliminated some traditional services, but it has also created access to better rates and more sophisticated financial management tools. Understanding these industry changes is crucial for seniors who want to optimize their banking relationships. The banks that dominated the industry when today's retirees were establishing their financial habits often no longer exist, having been acquired by larger institutions with different priorities and business models. The cozy relationships between local bankers and community members have largely been replaced by algorithm-driven systems designed to maximize profitability from customer relationships. This transformation isn't necessarily negative, but it requires a different approach from customers. Instead of relying on personal relationships and institutional loyalty, today's banking environment rewards customers who comparison shop, negotiate for better terms, and actively manage their financial relationships. Seniors who adapt to this new reality can often access better services and rates than were available under the old system. But those who continue operating under outdated assumptions find themselves increasingly disadvantaged. Margaret's experience with online banking illustrates another important aspect of financial evolution for seniors. Her initial resistance to digital banking was understandable given her concerns about security and complexity, but her eventual adoption of these tools dramatically improved both her financial outcomes and her quality of life. The time savings alone from automated bill paying and online account management gave her back hours each month that she could spend on activities she enjoyed rather than financial drudgery. The security benefits of online banking, once Margaret understood them, were actually superior to her paper-based systems. Multi-factor authentication, encryption, and real-time monitoring provided protection that was impossible with mailed checks and paper statements. The ability to immediately see transactions, set up alerts for unusual activity, and stop payments instantly gave her much better control over her finances than she'd had with manual systems. But perhaps most importantly, online banking gave Margaret visibility into her overall financial picture that had been impossible when her accounts were scattered across multiple institutions with different statement cycles and formats. For the first time in years, she could see all of her balances, transactions, and cash flow patterns in real time, which enabled much more strategic decision-making about her money management. The investment component of Margaret's transformation was equally revelatory. Her ultra-conservative approach to money management had felt safe, but it was actually the riskiest strategy possible because it guaranteed that her money would lose purchasing power over time. Learning to distinguish between appropriate risks and inappropriate risks was crucial to her financial evolution. Margaret's advisor explained that risk and volatility aren't the same thing, even though many seniors conflate them. Volatility refers to short-term fluctuations in account values, while risk refers to the probability of not meeting long-term financial objectives. A conservative portfolio might experience temporary volatility, but have a much lower risk of failing to fund Margaret's retirement needs than a cash-heavy approach that guaranteed erosion from inflation. This distinction was crucial for Margaret's peace of mind as she moved money from checking accounts into age-appropriate investments. She learned to focus on the long-term trajectory of her wealth rather than short-term account fluctuations, and she developed realistic expectations about the role of volatility in investment returns. The tax implications of Margaret's old habits were another eye-opener. Her cash-heavy approach was not only earning poor returns, but subjecting those minimal returns to the highest possible tax rates. By contrast, properly structured investments could provide better returns that were often taxed at lower rates or could be deferred entirely in tax-advantaged accounts. Margaret worked with a tax professional to optimize her withdrawal strategies from various accounts, coordinating her Social Security, pension, IRA distributions, and investment gains to minimize her overall tax burden while maximizing her spendable income. This strategic approach to tax management added thousands of dollars annually to her net retirement income without requiring any additional risk or complexity. The estate planning implications were equally important. Margaret's scattered account structure and suboptimal investment approach weren't just hurting her current financial security. They were reducing the legacy she could leave to her children and grandchildren. By optimizing her financial strategies for growth and tax efficiency, she was potentially adding hundreds of thousands of dollars to her estate while actually improving her current standard of living. Margaret's advisor helped her understand that retirement planning isn't just about making money last. It's about optimizing the balance between current lifestyle, financial security, and legacy goals. Many seniors sacrifice too much current enjoyment in the name of preserving wealth, while others spend too freely and risk running out of money. The optimal approach requires ongoing coordination between spending, investing, and estate planning strategies. As Margaret's new financial strategies began generating results, she experienced a profound shift in her relationship with money. Instead of anxiety about declining account balances and increasing expenses, she felt confident in a plan designed to help her wealth grow even during retirement. Instead of dreading monthly statements that showed fees and stagnant balances, she looked forward to reports that showed her progress toward long-term goals. This psychological transformation was as important as the financial improvements. Money anxiety is one of the most common sources of stress for retirees, and it can significantly impact both mental and physical health. Margaret's new sense of financial control and optimism improved her overall quality of life in ways that extended far beyond her bank balances. Margaret also discovered that optimizing her financial strategies didn't require constant attention or stress. Once her automated systems were in place and her investment allocations were properly structured, managing her finances actually required less time and energy than her previous manual approaches. The complexity that had intimidated her initially gave way to elegance and efficiency that made her financial life simpler, not more complicated. The social aspects of Margaret's financial transformation were equally significant. She joined investment clubs and financial planning groups for seniors, where she could share experiences and learn from peers who were navigating similar challenges. These communities provided both educational resources and emotional support for the ongoing process of financial optimization. Margaret also became an advocate for financial literacy among her peers, sharing her story with friends and family members who were making similar mistakes. She discovered that her experience was remarkably common. Most of her senior friends were paying unnecessary fees, earning inadequate returns, and missing opportunities for better banking relationships. The ripple effects of Margaret's changes extended beyond her immediate financial situation. Her improved financial security gave her more flexibility to help her adult children with their own financial challenges, to be more generous with her grandchildren, and to support charitable causes that were important to her. The money she saved through better banking and investment strategies became available for purposes that enriched her life and the lives of people she cared about. Perhaps most importantly, Margaret's experience demonstrated that it's never too late to make positive changes to financial strategies. While she wished she had learned these lessons earlier, the improvements she made at 67 still had the potential to add years of security and comfort to her retirement. The compounding effects of better financial decisions continue to generate benefits for as long as money remains invested, which means that even seniors in their 70s and 80s can benefit significantly from optimizing their banking and investment approaches. Margaret's story represents both a warning and an opportunity for the millions of American seniors who are unknowingly making similar expensive mistakes with their money. The banking habits that are quietly draining retirement savings can be identified and corrected, but only if seniors become aware of the problems and motivated to make changes. The financial services industry won't voluntarily help customers identify these problems because many of them represent profit centers for banks and investment companies. Fee income, spread income on deposits, and revenue from suboptimal investment products are significant sources of industry profits that depend on customer passivity and lack of awareness. This means that protecting retirement wealth requires becoming an educated and active financial consumer. Seniors need to regularly evaluate their banking relationships, compare their returns to available alternatives, and optimize their financial strategies for the current environment, rather than relying on approaches that may have worked well in the past. The good news is that the same forces that have made traditional banking relationships less valuable have also created new opportunities for savvy senior customers. Online banks offering superior rates, credit unions focused on member benefits, investment platforms designed for individual investors, and fee-only advisory services provide alternatives that can dramatically improve financial outcomes for seniors willing to explore them. The key is overcoming the inertia and intimidation that keep many seniors trapped in suboptimal financial relationships. This requires acknowledging that the financial landscape has changed, accepting that some complexity is unavoidable in the modern financial environment, and committing to the ongoing process of financial optimization that today's environment requires. Margaret's transformation wasn't completed overnight, and it wasn't without moments of doubt and frustration. Learning new systems, changing decades-old habits, and navigating unfamiliar financial products required persistence and patience. But the financial and psychological benefits of these changes made the effort worthwhile, and Margaret's only regret was not making these changes sooner. The 5 banking habits that were destroying Margaret's financial security: multiple fee-generating accounts, keeping all money in low-yield deposits, manual bill-paying systems, misplaced bank loyalty, and excessive cash hoarding, represent systemic problems that extend far beyond individual cases. These habits are costing American seniors billions of dollars annually, money that should be funding comfortable retirements, healthcare needs, and family legacies. The banking industry has evolved into a sophisticated machine designed to extract maximum profits from customer relationships, and seniors represent particularly attractive targets because they tend to be loyal, trusting, and less likely to shop around for better deals. The personal relationships and community connections that once provided some protection against predatory practices have largely disappeared, replaced by algorithm-driven systems that optimize for bank profitability rather than customer welfare. Understanding this reality doesn't require becoming cynical about financial institutions, but it does require approaching banking relationships with appropriate skepticism and regular evaluation. Banks are businesses designed to make money from customer relationships, and seniors who don't actively manage these relationships will find themselves subsidizing bank profits at their own expense. Margaret's experience also highlights the importance of financial education tailored specifically for seniors. Traditional financial advice often focuses on wealth accumulation strategies appropriate for younger people, but retirees have different challenges that require specialized knowledge. Understanding how to optimize banking relationships during retirement, how to structure investments for income generation, and how to coordinate various financial accounts and strategies are skills that many seniors never had the opportunity to develop during their working years. The complexity of modern financial services can be overwhelming, but it's important to recognize that this complexity also creates opportunities. Seniors who invest time in understanding their options and optimizing their financial relationships can often achieve better outcomes than were available to previous generations of retirees. The key is finding trusted advisors who can help navigate this complexity without taking advantage of senior clients. Margaret's advisor emphasized several principles that are crucial for senior financial success in today's environment. First, loyalty should be earned, not given automatically. Financial institutions need to demonstrate their value through competitive rates, reasonable fees, and quality service. Seniors who remain loyal to banks that don't reciprocate are essentially volunteering to subsidize those institutions' profits. Second, simplicity and optimization aren't mutually exclusive. While Margaret's initial financial setup was simple, basic checking and savings accounts at familiar banks, it wasn't optimized for her current needs. True simplicity comes from having systems that work efficiently in the background, not from avoiding all complexity at the expense of performance. Third, the biggest financial risks for retirees often aren't the obvious ones. While Margaret worried about market volatility and investment losses, her greatest actual risk was the guaranteed erosion of purchasing power from keeping money in accounts that couldn't keep pace with inflation. Learning to distinguish between perceived risks and actual risks is crucial for making sound financial decisions. Fourth, small changes can have enormous cumulative effects. Margaret's individual banking habits might have seemed relatively minor, a few $100s in fees here, a few percentage points of lost returns there. But over the course of a multi-decade retirement, these seemingly small inefficiencies can cost hundreds of thousands of dollars. Finally, it's never too late to optimize financial strategies. While Margaret wished she had made these changes earlier, the improvements she implemented at 67 still had the potential to significantly enhance her financial security for the remainder of her retirement. The emotional journey of confronting and changing long-established financial habits cannot be understated. For many seniors, acknowledging that their current approach isn't optimal requires overcoming pride, fear, and decades of ingrained behaviors. The institutions they've trusted for years may not be serving their best interests. The strategies that worked during their working years may now be counterproductive, and the financial landscape may have changed in ways they didn't fully understand. Margaret's initial reaction to learning about her costly banking habits was a mixture of anger, embarrassment, and overwhelming anxiety. She was angry at banks that had taken advantage of her loyalty, embarrassed that she'd been making expensive mistakes for years, and anxious about making changes that felt risky and unfamiliar. These emotional responses are normal and understandable, but they can also prevent seniors from taking the actions necessary to improve their financial situations. Working through these emotions required Margaret to reframe her relationship with money and financial institutions. Instead of viewing her previous approaches as failures, she learned to see them as reasonable responses to a different environment that had changed around her. Instead of feeling overwhelmed by the complexity of optimizing her finances, she focused on making incremental improvements that would compound over time. The support system that helped Margaret navigate these changes was crucial to her success. Her financial advisor provided expertise and objectivity. Her adult children offered encouragement and assistance with technology, and her peers who had made similar transitions shared their experiences and lessons learned. Changing established financial habits is difficult to do alone, and seniors benefit enormously from professional guidance and personal support during these transitions. Margaret's transformation also required developing new skills and comfort levels with technology that initially felt intimidating. Online banking, automated systems, and digital financial management tools required learning curves that were sometimes frustrating for someone who had managed money manually for decades. But the efficiency and control that these tools provided ultimately made Margaret's financial management both more effective and less time-consuming. The security concerns that initially prevented Margaret from embracing digital banking were addressed through education and gradual implementation. She learned that online banking security had evolved significantly and that properly implemented digital systems were actually more secure than paper-based alternatives. Starting with simple online account monitoring and gradually adding features like automatic bill pay and mobile deposits allowed her to build confidence and competence over time. One of the most significant revelations in Margaret's financial transformation was understanding how inflation had changed the retirement planning equation. During her working years, conservative savings strategies could provide real returns that kept pace with or exceeded inflation. In the current low-interest rate environment, these same strategies guarantee that money will lose purchasing power over time. This shift required Margaret to reconsider her entire approach to risk and return. What felt like the safest strategy, keeping money in familiar bank accounts, was actually ensuring a gradual but certain loss of wealth. What seemed risky, investing in diversified portfolios that could experience short-term volatility, was actually the more conservative approach for preserving and growing purchasing power over time. Learning to think about risk in terms of purchasing power rather than account balances was a crucial conceptual shift. Margaret's advisor helped her understand that a portfolio that maintained its value after inflation was more valuable than a bank account that maintained its nominal dollar amount while losing purchasing power. This perspective helped her become more comfortable with investment approaches that could experience temporary fluctuations but offered better prospects for long-term wealth preservation. The tax implications of Margaret's financial optimization were more significant than she had anticipated. Her previous approach of keeping money in taxable bank accounts while leaving tax-advantaged retirement accounts untouched wasn't optimal for her overall tax situation. Strategic coordination of withdrawals from different account types could significantly reduce her annual tax burden while providing the same or better cash flow for living expenses. Margaret worked with a tax professional to develop withdrawal strategies that optimized her tax efficiency across all of her accounts. This included timing IRA distributions to manage tax brackets, coordinating investment gains and losses to minimize capital gains taxes, and structuring her overall portfolio to maximize after-tax income. These strategies added thousands of dollars annually to her spendable income without requiring any additional risk or complexity. Estate planning considerations also influenced Margaret's financial optimization. Her previous approach of keeping money in basic bank accounts wasn't just suboptimal for her current needs, it was also reducing the legacy she could leave to her heirs. By investing for growth and coordinating her estate planning with her investment strategies, she could potentially leave significantly more to her children and grandchildren while actually improving her current standard of living. Margaret's advisor helped her understand the various estate planning tools available to seniors with substantial assets. Revocable living trusts could help avoid probate and provide more control over asset distribution. Charitable giving strategies could reduce taxes while supporting causes she cared about. Long-term care insurance could protect her assets from potential healthcare costs, while ensuring she could afford quality care if needed. The coordination between Margaret's banking optimization, investment strategy, tax planning, and estate planning created synergies that were much more powerful than addressing each area separately. Her consolidated banking relationships made it easier to manage required minimum distributions from retirement accounts. Her automated bill-paying systems ensured that insurance premiums and other critical expenses were always paid on time. Her diversified investment portfolio provided both current income and growth potential to fund her long-term care and legacy goals. As Margaret's new financial strategies began generating results, she experienced a profound transformation in her relationship with money and retirement. Instead of anxiety about declining purchasing power and increasing expenses, she felt confident in strategies designed to help her wealth grow even during retirement. Instead of constantly worrying about fees and poor returns, she looked forward to statements that showed progress toward her long-term goals. This psychological shift had ripple effects throughout Margaret's life. Her improved financial confidence made her more willing to spend money on things that enhanced her quality of life, travel, hobbies, gifts for family members, and charitable contributions. She realized that optimizing her financial strategies wasn't just about preservation, it was about creating the security and flexibility to enjoy her retirement years fully. Margaret also became more engaged with financial planning as an ongoing process rather than a one-time event. She scheduled regular reviews with her advisor, stayed informed about changes in tax laws and financial regulations that might affect her strategies, and remained open to adjustments as her needs and circumstances evolved. This active approach to financial management became a source of empowerment rather than stress. The social aspects of Margaret's financial transformation extended beyond her immediate family. She joined investment clubs and financial planning groups where she could continue learning and share experiences with peers facing similar challenges. These communities provided both ongoing education and emotional support for the continuous process of financial optimization. Margaret also discovered that her improved financial situation gave her more opportunities to help others. She could assist her adult children with their financial challenges, be more generous with her grandchildren's education expenses, and support charitable causes that were important to her. The money she saved through better banking and investment strategies became available for purposes that enriched her life and the lives of people she cared about. Perhaps most importantly, Margaret's experience demonstrated that financial optimization is an ongoing journey rather than a destination. The strategies that worked best for her at 67 might need adjustment as she aged, as her health changed, as the economic environment evolved, and as her priorities shifted. The key was developing the knowledge, confidence, and support systems necessary to continue making optimal decisions throughout her retirement years. The broader implications of Margaret's story extend far beyond individual financial planning. The systemic nature of the banking habits that were draining her retirement savings suggests that millions of American seniors are facing similar challenges. The banking industry's evolution toward fee-based revenue models, the low-interest rate environment that has made traditional savings strategies obsolete, and the increasing complexity of financial services have created widespread problems for retirees who haven't adapted their strategies accordingly. Addressing these problems requires both individual action and broader structural changes. Seniors need better financial education, tailored to retirement-specific challenges, more transparent information about banking fees and alternatives, and stronger consumer protections against predatory practices that target elderly customers. Financial institutions need incentives to provide better service to senior customers, rather than simply extracting maximum fees from their loyalty and passivity. Regulatory authorities need to recognize that the current financial services environment can be particularly challenging for seniors and consider policies that promote transparency, competition, and consumer protection. Professional organizations for financial advisors need to develop better standards and training for serving senior clients, who have different needs and vulnerabilities than younger customers. The good news is that awareness of these issues is growing, and resources are becoming available to help seniors navigate the modern financial landscape more effectively. Online tools for comparing banking services, educational programs focused on retirement financial management, and advocacy organizations dedicated to senior financial protection are all becoming more prevalent and sophisticated. Margaret's transformation from financial victim to empowered consumer represents the potential that exists for millions of American seniors who are currently trapped in suboptimal banking relationships and investment strategies. The habits that are quietly draining retirement savings can be identified and corrected, but only through education, advocacy, and the courage to challenge assumptions that may no longer serve senior clients' best interests. The 5 specific banking habits that devastated Margaret's financial security: maintaining multiple fee-generating accounts, keeping all money in low-yield deposits, avoiding automation and online banking, remaining loyal to banks that don't reciprocate, and hoarding excessive cash, are symptoms of broader disconnects between traditional retirement planning assumptions and current financial realities. The solutions aren't just technical, they're also psychological and social. Helping seniors optimize their banking relationships requires addressing fears about technology, concerns about financial complexity, and emotional attachments to institutions and approaches that may no longer serve their best interests. It requires building confidence in new systems and strategies while providing ongoing support and education. Margaret's story is ultimately one of empowerment and hope. Despite making expensive mistakes for years, she was able to identify and correct these problems in ways that dramatically improved her financial security and quality of life. Her experience demonstrates that it's never too late to optimize financial strategies, and that the benefits of making these changes can be substantial even for seniors who are well into their retirement years. The transformation wasn't easy, and it required overcoming significant emotional and practical obstacles. But the results, thousands of dollars in annual savings, dramatically improved investment returns, better financial organization and security, and most importantly, peace of mind about her financial future, made the effort worthwhile. Margaret's message to other seniors facing similar challenges is clear. Don't accept financial mediocrity as inevitable. The banking habits that are quietly draining retirement savings can be changed, and the benefits of optimization extend far beyond dollars and cents. Taking control of banking relationships, investment strategies, and overall financial management can provide not just better financial outcomes, but also the confidence and security that make retirement years truly golden. The 5 worst banking habits that cost seniors thousands: multiple fee-generating accounts, low-yield deposits, manual payment systems, misplaced loyalty, and excessive cash hoarding, represent problems that are both widespread and solvable. Margaret's transformation from victim to victor shows that with the right knowledge, support, and determination, any senior can break free from these wealth-draining patterns and build the financial security they deserve. In the end, Margaret's story isn't just about banking habits. It's about the importance of remaining engaged, curious, and proactive about financial management throughout retirement. The seniors who thrive in today's complex financial environment are those who continue learning, questioning, and optimizing their strategies as circumstances change. Those who remain passive and assume that old approaches will continue working find themselves systematically disadvantaged by an industry that profits from their inaction. Margaret's journey from financial complacency to empowerment offers both a warning and an inspiration. The warning is clear. Traditional banking approaches are quietly devastating senior finances in ways that many retirees don't recognize until significant damage has been done. The inspiration is equally clear. With proper knowledge and action, these problems can be solved, and the remaining years of retirement can be both financially secure and personally fulfilling. At 70 now, 3 years after beginning her financial transformation, Margaret looks back on her journey with gratitude for the lessons learned and optimism for the years ahead. Her improved financial strategies have added hundreds of thousands of dollars to her projected retirement security while reducing stress and increasing her quality of life. Most importantly, she has developed the knowledge and confidence to continue making optimal financial decisions for whatever challenges and opportunities her remaining years may bring. Margaret's story continues to evolve, but the foundation she has built, smart banking relationships, diversified investments, automated systems, and ongoing professional guidance, provides the security and flexibility she needs to enjoy her retirement fully. The 5 devastating banking habits that once threatened her financial future have been replaced by 5 empowering financial practices that support her goals and values. Her legacy extends beyond her own financial transformation. By sharing her story and advocating for better senior financial education, Margaret has helped other retirees avoid the mistakes she made and optimize their own financial strategies. Her experience has become a catalyst for broader conversations about senior financial protection and empowerment. The ultimate lesson of Margaret's journey is that financial security in retirement isn't just about how much money you've saved. It's about how wisely you manage what you have. The banking habits that quietly drain wealth can be just as devastating as major financial catastrophes, but unlike market crashes or economic recessions, these problems are entirely within individual control. Every senior has the power to evaluate their banking relationships, optimize their financial strategies, and take control of their retirement security. Margaret's transformation proves that it's never too late to make changes that can dramatically improve financial outcomes and quality of life. The question isn't whether these improvements are possible. It's whether seniors will take the actions necessary to achieve them. Margaret's story ends not with a conclusion, but with a continuation. Her optimized financial strategies continue generating benefits. Her ongoing education continues revealing new opportunities for improvement, and her advocacy continues helping other seniors avoid the mistakes she made. At 70, she is more financially secure, more knowledgeable, and more confident about money management than she was at 67 when her journey began. The 5 worst banking habits that cost seniors thousands are preventable, correctable, and ultimately unnecessary. Margaret's transformation from victim to victor shows that any senior can break free from these wealth-draining patterns and build the financial security they deserve. The only question is whether they will choose to take action or continue accepting financial mediocrity as inevitable. For the millions of American seniors currently trapped in suboptimal banking relationships and investment strategies, Margaret's story offers both a warning and a beacon of hope. The habits that quietly destroy retirement security can be changed, and the benefits of optimization extend far beyond improved account balances. Taking control of financial management in retirement can provide not just better outcomes, but also the confidence and peace of mind that make the golden years truly golden. Margaret Hensley's journey from financial victim to empowered consumer represents the potential that exists within every senior who is willing to challenge assumptions, embrace necessary changes, and take control of their financial destiny. Her story proves that the 5 worst banking habits that cost seniors thousands are not permanent sentences, but problems with solutions that are within reach of anyone willing to pursue them.